the 16th of September. Normally, I will be doing this at night, but we have so much going on, the amount of calls that we've been getting, I thought it'd be in our best interest to get this out to you as soon as possible. Plain and simple, I think, how would I say it? I thought it would be better to get this out this morning to help everyone out. So if I was going to talk to you about what's happening today in our market, pretty simple. Saudi Arabia, and obviously I'm not able to spell it all, had a drone attack that basically cut world supply, come on, Hurley, world oil supply by 5.7% for the near term. The U.S. basically told the world, and I'm pretty sure it was Pompeo and Trump, told the world via tweet and press release, quote unquote, we are locked and loaded. Our belief, it was Iran. So we basically told the world, hey, we know who it is. We're ready to go. But it's a little bit worrisome that Saudi Arabia has not specifically said who was at fault. Now, there was a group that came out and said, hey, we did it. I'm trying to find out who that was. $7 million barrels or 5%. So it's 5.7 million barrels, excuse me. Multiplied by 5% or 5.7 million barrels a day shortfall. Supposedly, Yemen's, I don't even have to say it, Houthi rebels claimed responsibility. So it's kind of funny if Yemen rebels have taken responsibility, the question is, why is Iran in the mix here? Why is Iran all of a sudden all ready to get on this and to fight the fight? Why are we so anxious to start a problem there? And basically it comes down to because we already have a problem there. It's not that we're anxious, but we already don't like the country. So it's going to sound pretty controversial. It's going to sound like a conspiracy theory. But if there's a problem in the area, you go ahead and you pick the fight when you're the biggest person on the block, which I would deem the U.S. to be. You go and you pick the fight with the people that you like the least. That way you now have justification to attack, cripple economically. You know, I could throw all kinds of conspiracy theories in here. Plain and simple, you You go and you find the person you want to attack and you blame them. It's that simple to understand, and it's that simple to see where things are going. So, with that said, futures last night. Can't spell worth beans day. Futures last night around 3 a.m. my time had come down to 133 down on the Dow. And down 12.75 S&P from highs earlier at almost 200 on the Dow and 25.75 on the S&P. So as I looked at futures this morning, I wasn't so worried. Also, Europe and Asia didn't take a huge hit. So this is kind of important because really, if you look at where we're having our problems now, it all comes down to China. Lower than expected retail sales. In fact, their numbers came in horrible this morning. Retail sales, industrial production, both missed. A lot of people ask me, Kevin, where do you look at this? Where do you see it? I usually go to the economic calendar from the FX Street. If you want to day trade or Forex, you need information pretty quickly. This is where I pick mine up for free. Numbers that came in today. Where the heck are they? There we go. Actual retail sales came in at 7.5 versus 7.6. Industrial production was the big one. Excuse me, 7.5 from 7.9. Their previous was 7.6. Industrial production 4.4 versus a 5. That was the big miss. And because of that, China's Li came out and said it would be very hard to maintain the 6% GDP growth in a world slowing economic cycle. They didn't point out that the U.S. tariffs were hurting them. So we have a lot stacked up against us in regards to what's going to worry us, what's going to happen. And that brings up what I wanted to talk about today. Long put protection for stock ownership. When, how, why, cost, adjusting. And I'm going to work on each and every one of these one by one. So let's start off with the why. If you go back to a week ago, I talked about why we collar trade. Why do you put long put protection on? In fact, let's even do this a little bit differently. A long put is equal to the right to sell your stock at a certain price for a certain period of time, i.e., stock insurance. You pay a premium for protection for a certain period of time. So, why do we do it? To make up some of the downward movement on stocks, which will then come to, if I have it in here, when, right? When do we do it? So for me, prior to earnings, and the reason why is because the probabilities of stock ownership heading bearish are highest during this time period. Number one reason why stocks go down is earnings. It's not black swan events like what happened over this weekend. It's not management change, product. It's earnings. Earnings, and guidance. They're one and the same. They both come out at the same time. So 4 times a year, you'll see a spike of volatility, somewhere between 50 to 100% volatility spike on stock ownership. And that time period occurs during earnings. That is when you have the highest probability of things going bad for you. So a lot of people ask me, well, how do you protect yourself during a black swan, right? And the honest answer is, I don't protect myself for a black swan event. Something that's going to happen, a 0.5% of all the time that you're in the market. I'm not protecting people's portfolios for the black swan event. Was I saved in 2000 when it all hit the fan? Of course I was. Taking a look at my portfolio right now. 10.8 million. S&P is down 0.26. I'm down 2,451. Clearly, I'm not down $26,000. I'm handily beating the S&P. Is it because of diversification? No. I've got multiple positions on Apple. Looks like covered calls and a put vertical. Boeing, I've got long protection already on a put vertical form. Baidu is just, it's really out there on its own, in all honesty. Let's see what else. CBOE has a put vertical on it. Ford has nothing on it. Disney has nothing on it. I do have protective put on FCX. I've got some protection on Visa. So the neat thing is, I'd love to tell you, hey, diversification solves everything. That is not correct. What is solving things is some protection I have in place. My biggest loser today is Disney. I'm not protected on Disney. Disney's running up against Apple, opening up their stuff. Bob Iger got off of the board. Disney is my biggest loser today. So as I look at my accounts or my status, my question is, if I need to go put protection on Disney, where would I go? Well, I'm first going to take a peek and I'm going to say, hey, if I was going to look at Disney, what point do I put protection on? Well, it seems like it's holding or has some level of support roughly at that 135 area. Touched a couple days, touched it, bounces higher, was building a base around it for the whole month of August. So my protection to let it move is going to sit somewhere between 135 and somewhere between 139.08, which is the 50-day simple moving average. My expectation, I put it at 135, it would come down to 125. This would be the first area I'd look to take it off. Maybe a little premature without having technical crossovers bouncing up, but I would be playing some type of support level on an institutional level at the 200-day simple moving average. So if we came back to when, I would also put in here stock, technical bearish crossovers, and index technical bearish crossovers would be when I would put it on, or obviously prior to earnings. How do I do it? At the money. At the money is the best bang for the buck. Reason why. It protects the current price of the stock. If I was cheap and went to out of the money, then I have more real dollars or money at risk when I lose on the stock and the long put premium I paid for protection. If I go way in the money, then I am overpaying for the protection and lose the profits from a stock heading higher. So let's take a peek at Disney. Disney's down at 135.50. If I had earnings coming up next week or something I felt I needed to protect myself for, I would go to Disney, I would go to options. I want to make sure I'm at least out 30 days to avoid volatility crush. I see I have October, I'd probably go out 32 days to an odd strike month. That gets me not in the month of options expiration, since September is going to expire in 4 days. I'm going a little outside of the October typical ones. In fact, you know what I'd probably go, in all honesty? I would go out to the October 25th. So that way, next week when we get into the month of options expiration, I won't have a big drop down on Disney. I'm also hoping for some single digit, there we go, some single digit positions to be in. So if Disney right now was at 136.55, I would most likely be buying the 130, well, I'd work both numbers. Let's look at 136 at 192. Excuse me, need to get a pencil to write some of this down. Disney, 136, I'd be looking at $1.90. 137, I'd be looking at $2.35. And the stock is trading at 136.57. So let's work our numbers. Cost. Stock ownership or current price is going to be 136.57. Buy to open, a 136 long put. I'm looking at either strike that would be considered at the money for $1.90. New cost basis is equal to the stock at 136.57 if you're putting it in, plus the 190 long put, comes out to, and I'm going to use a calculator so I don't ever make a mistake, 136.57 plus $1.90 comes down to 138.47. Risk in position. Let's let you be able to see it a little bit more. Risk in the position is equal to 138.47 minus my 136 long put protection, or long put, I should say 136 right to sell, comes down to $2.47, or 247 divided by 138.47 is 1.78% of total invested position. I would say capital, but maybe some of you got in a little bit earlier. Maybe you've got a cost basis significantly lower. If we take a look at where I'm at, one more time, I'm at Disney, where I've got some Disney stock ownership with an average cost basis of $115.86. So I'm protecting roughly $21 of profit, right? That's my decision. I'm looking at protecting $21 of profit and making something on the way down. Do I spend a little more? Do I do this whole thing and see if I really don't like where the risk of war is going to be at? So do I look at the 137 where I'm now going to pay $2.35? Oh, I'm spending more money. I'm spending more money. Is it a good idea? If I change these positions around just a little bit to 35, when I add everything together, my new cost basis should be 238.92, which means if I've got the right to now sell at 137, I only have $1.92 at risk. And if I take $1.92 and divide it by 138.92, I now have 1.38% of risk in my total investment position. So my worry about Disney, next earnings doesn't come up until next earnings doesn't come up till 11/7. So I want to protect it out till just before earnings. The cost of doing that protection, well, I guess it's not a simple cost matter. Do I want 1.78% of my total position protected or 1.38? I would lean to 1.38 because if there is a war on Iran, all world markets are going to fall. So it would be a preemptive worry. I did like it the last time Trump decided not to do an attack, that he said, hey, there's too much collateral damage. But here we go. This is my position. This is where I would be. What am I not taking advantage of? Adjusting. So, my adjustment. Take off long puts for a profit at 139. Add short puts when the stock price goes down to 135 maybe. And I would add them at the 125 level, because that would be the next stop on the way down at the 200-day simple moving average. Add short puts if the stock goes sideways at 130. Now, my understanding, I'm adjusting to make up some of the cost in long puts, but not trying to make up every penny. There has to be a premium associated with protection. I'm not going to lose my butt on it, but if I could lower this down to 0.5% to be protected till just before their next earnings, or I'm going to reset it anyway, I'm okay with that. 0.5% is the cost of doing business. I'm not going to go sell a 134 when the stock's up at 139 and can bounce lower. I'm not interested in putting a position on that the difference between my long put and my short put credit, that debit is more than my difference in my spread. I still want some protection here. Well, Kevin, if it goes up, it can come back down. I could start out at 130 and roll it up to 139 if after 2 or 3 days, Disney holds its 50-day simple moving average. My adjustment is not to make up every penny. That's unrealistic. That isn't giving you protection. It's spread trading foolishness. But I would only want to pay maybe 0.5%. Maybe even 0.75% if I had to. But this is how I look at my long puts, because I know anything I make up on the way down is a profit when stock prices come back up. I know it levels out the volatility and swings, and I should say portfolio swings, because there is some kind of protection in play. Also, leap long calls is a form of protection by only investing 10 to 15% of the stock price for a 2-year period of time. I'll go into that one next week. So as I look at everything, just to give you a heads up, where will our markets end this week? I would probably tell you we might be to the downside. And I would say down because we have to, at least on the Dow, right? Because we have to break a base that was being built. I could see us sideways, actually. Let me take that back. Let me take all this back. I'm going to say sideways. And I'm going to say sideways because of the risk or threat of a obviously international war, but we do have the FOMC rate decision. We'll probably get another cut on Wednesday. Not to mention we have options expiration on Friday, which when I take a look at the market, we've had a pretty good rise, which means we're probably going to see some profits or probably some, I don't know. Really no short covering because things have gone up. So a whole lot of new short positions probably haven't been put on for September. But I do typically look at September and think we're going to come back here and maybe only be up 1% or even be down 1%. I think it's closer that we're going to test 2,600 or the 200-day simple moving average before we're going to go back and test all-time highs. So this one will be pretty interesting. This picture was taken on Sunday, by the way. We are down a bit today, about 100 points, right? So I'm going to say our market will probably be sideways this week. We are bullish on all three of our indexes, but we're testing some highs. The political situation or world politics is not helping us out. I still think the S&P will end September down 1% or flat. Earnings this week, we have Adobe and FedEx on Tuesday, market movers. Darden Restaurants on Thursday. Wednesday, General Mills. Economic reports, not a whole lot coming on for economic reports this week. I just don't see anything other than the FOMC rate decision that will validate or that will be a game changer. I just don't see it. If we even came back and looked at the Empire manufacturing number, which actually doesn't come out till came out in a 2. Awful. Lower than expected Empire manufacturing numbers. But again, it's not a market mover. Not a market mover, not something we need to worry about. China retail sales industrial production was down. China's home price index will most likely be down as well. That might affect our futures tomorrow. As how am I looking to trade? I'm looking at long term, and I might start particularly for October earnings. That's already been in place. I do have some interesting, at least I consider interesting, some pretty interesting articles to read through. Stocks are expected to break out. I think that all comes down to some type of China negotiation, but please read through it. We do have some technicals. We are breaking above it. Pretty interesting reading to see how volatile our market can be. I put an article on the all new Apple products are just announced. If you like Apple, please read through all of this. Very interesting on their announcement. Kramer says buy stocks, high quality companies, and the market investors are dumping. Again, just basic, simple understanding of buying low and selling high. I found an article on Bank of America. We are heavily invested in Bank of America and stock positions as well as deep long calls. Do look at their charts. Their charts are pretty good, but valuation is so low it looks attractive on an institutional level. What else do we have for you? The epic industry shift. This will be our next biggest drop, but it'll be a scare tactic. Passive income is now bigger than active, which once again is simple to say. People think that diversification protects them in market downturns, yet everyone runs the hell out of the market. And because there's so much more passive than active management right now, we're looking at a crash bigger than the 38% we had in 2008. European Central Bank cuts its deposit rate and launches a buying program. We are seeing the ECB instigate a quantitative easing program out in Europe to boost them. And with that said, I normally go through some questions, but obviously I don't have Ben here with me today. I just want you guys to know where we're positioned right now. We look good. We're somewhat easily beating the market today. Obviously, we're looking at putting some protections on. We'll probably not do that until the close. We'll get through our East Coast going to lunch from 10:30 to 11:30 Mountain Standard Time, which is really 12:30 to 1:30. And usually Europe closes just before that, where we could see some money shift from Europe over to the US as an investment. Nothing to worry about yet, but we do have the risk of retaliation and a war against Iran from both Saudi Arabia and the United States. I don't think China or Russia would back Iran at this point in time, but that doesn't mean that there aren't significant other Middle Eastern countries that would back Iran, which would just cause some type of powder keg to explode out there in the Middle East. So that's the risk that we're running right now. Guys, have a wonderful week. I look forward to seeing you Tuesday night. I'm going to get this here posted quickly so that everyone can see and hear it. If you do have questions, don't hesitate to go ahead and email those questions to khurley@hurleyinvestments.com. Trying to find that. So if you do have questions, concerns, or worries, or you do want to make a comment, khurley@hurleyinvestment.com. You could also email something to customer service at hurleyinvestments.com, and that would get passed on to me. Guys, ugly start to the week. We really are waiting on the FOMC rate decision, which will probably keep our markets sideways and in check on Tuesday. Wednesday will be the market moving day, and from there we're going to be in position to be okay. Definitely, it's basically 100% 25 basis rate cut that's preemptive. We might have 50 basis points, but that won't leave them anything for October or December. So expect a quarter point rate cut. And the markets this time, I would assume, would like it, and we will head higher on Wednesday. Again, any questions, khurley@hurleyinvestments.com, our customer service, and I'll try to get those emailed responses out to you over today's market commentary. No panic, no worry today, guys. We're looking good. I'll talk to you tomorrow night for the trade findings and adjustments at 6 p.m. Mountain Standard Time. Hope to see you then, and have a good one. Bye-bye.